So about 125 years, give or take, since its founding. And it looks like Sears chairman Eddie Lampert's $4.4 billion bid will not be enough to save the once dominant department store. Sources familiar with the matter tell CNBC.com's Lauren Hirsch that Sears advisors had given ESL and that's Eddie Lampert's hedge fund, until this morning to sweeten its bid before officially filing for liquidation. As of very late Monday night, the bid was not sufficient. ESL this morning declining to comment. Now, when Sears filed for Chapter 11 bankruptcy in October, Lampert stepped down as CEO. He remains chairman, personally owning 31% of Sears shares. His hedge fund ESL owns 19%. He and his fund are both the largest equity and debt holders for Sears Holdings. Before the bankruptcy filing, Lampert had actually proposed a plan to restructure to avoid it, but that came only after years of various complicated financial engineering maneuvers that Lampert and his hedge fund undertook to keep Sears running. And while the doors were open, it wasn't going well. Sears Holdings hasn't made money in 7 years. Shoppers have been complaining of empty shelves and racks at deteriorating Sears and Kmart stores for some time. Now, Sears Holdings had about 4,061 stores in 2011. When it filed for bankruptcy, it had about 700. At its sales peak in 2007, Sears Holdings was raking in more than $53 billion. In its most recent fiscal year, which was reported last January, they pulled in more than about $17 billion in revenues. But when they filed for bankruptcy, they had liabilities of more than $11 billion and assets of just more than $7 billion. So today could be a very big day, but a sad one for the 50,000 Sears employees.
And
back
of course,
over to you.
The great irony being that Amazon just became the most valuable company in the world on the same day that Sears.
And you know what else is really ironic, Andrew, is that Sears, I would argue, was perhaps one of the most well-positioned companies to actually fight Amazon. Think about the catalog, like you guys were talking about. Right. It had an infrastructure to sell direct to consumer, to shift the catalog online, all of those facilities, and they just didn't take the opportunity to do so.